Okay, everybody, I have just after the hour 1 o'clock, so we will get started here. My name's Ian Campbell. I'm the Vice President of Operations here at PACICC. I'm the staff lead for the Risk Officers Forum, and I'm your moderator for this afternoon's broadcast. I want to welcome everybody, and special welcome to our first-timers joining us here for the first time. This is our first webinar of 2022. I want to thank my colleague, Danica Hall. She's working behind the scenes to ensure a very smooth broadcast, so thank you, Danica, for that. And I encourage you to relax and enjoy yourself over the next 90 minutes. We've structured this like a talk show format. We have three colleagues from the industry joining us to talk about risk identification and risk assessment. And I think you're going to find this quite interesting. Very, very interesting subject matter. It's always our most popular webinar of the year, where you get a chance to see what the inner workings of another organization, what they're doing and what's contributing to their success. So Danica has posted the agenda here. I'm going to look at I'm just going to go through a couple of housekeeping items. We're going to hear then from our President and CEO, Alistair Campbell. He's going to say some words of welcome to you. And then we'll jump right into our industry panel discussion. And we're going to close the broadcast with looking ahead in your calendar, chance to mark dates in your calendar, the other Risk Officers Forum events and Emerging Risks webinars for the balance of 2022. And then I'm going to talk about the satisfaction survey that you're going to be mailed tomorrow. This is our first time using the webinar format in MS Teams. So everyone, if when we invite you to provide questions or comments, we ask you to use to put your hand up, and Danica will then call upon you. She'll unmute you, and you can provide your question or your comment to our panelists. But it's a little bit different than past broadcasts. And that will make for a very smooth broadcast. I do have to tell you that the antitrust or the Competition Act applies now, and it remains in effect throughout the broadcast. Our lawyers like to hear that. No collusion. All the matters we're going to talk about are for discussion's sake, and this is not planning behind the scenes in some discrete forum. The meeting is being recorded, and that will be of interest. If anyone is not able to join us now, they can find this on the PACICC website shortly after the broadcast. So now I will throw it over. That's the end of the housekeeping items. I'm going to throw it over to Alistair Campbell, our President and CEO, for a few words of welcome, and then I will take back control. Over to you, Alistair. Thank you.
Thanks so much, Ian, and thanks all for joining today. And thanks in advance to our elite panel for volunteering to share their insights and wisdom on emerging risk. Just to appreciate that there are always risks emerging. I think this is the first PACICC webinar that I've participated in the middle of a land war in Europe. And so I think we're all conscious, one, that risks are always changing, and two, we're very blessed to live in Canada and to have our businesses and families here. So very quickly on the PACICC topics, we are engaged in some serious thinking about our priority issue for the year, which is a review of the size, scope, scale, and adequacy of our compensation fund. Last year, we published a research paper that showed that if we had 250 million in the bank, it would be very handy to help mitigate systemic risk after a significant earthquake. We've got 60 now. And previously we had published research showing that 60 million wasn't actually adequate for the official purpose that we'd established the fund for in the mid-90s. So last year we did some thinking about whether reinsurance could be used to fill the gap. This spring we've been doing some work on whether a standby line of credit of some form could fill that gap, as it did when we were founded. And we are also doing some kind of deeper thinking with our board about whether or not we should reinstitute some form of annual contribution to the compensation fund via the industry through the kinds of capital levy that allowed us to establish the fund in the first place. So that's not a small topic. It will take us some time to work our way through it, but we are exploring all our avenues as a prelude to some board deliberations later this year. Our permanent priority issue is working with Ottawa and the provinces to address the risks associated with the megaquake. There is an event simply too large for our richly capitalized and very well reinsured industry to handle. And so at that point, some form of federal backstop mechanism is essential. And Canada is an outlier among developed nations with serious quake exposure in not having some form of backstop mechanism already in place. It's a fundamental gap in the public infrastructure of our country. And COVID, if anything, has demonstrated how useful it is to have plans for tail risk in advance of those risks actually materializing. And so the good news is that the collaborative work that's being done between IBC and ICLR and PACICC is leading to the formulation of some, I think, very compelling solutions to the whole stakeholder map of that problem. Underinsurance in Quebec, inadequate coverage in British Columbia, industry tipping point risk, and huge contingent liability for the federal and provincial governments if underinsurance, uninsurance, and a collapsing industry actually were to materialize. And in that context, the atmosphere in Ottawa to hear about this is better than it has ever been. And that, I think, is particularly because on top of COVID demonstrating that a plan in the drawer in advance was handy, the BC flooding that just occurred proved to be a fundamentally uninsured event with tens of billions of dollars in economic losses and roughly $500 million of insured loss. That is ending up as a massive contingent liability, which is being currently funded in deals that are still being worked out between the federal government, the provincial government, and the damaged parties, farms, businesses, homeowners. That is going to cost the taxpayers in an unplanned way material amounts, billions. So Ottawa, I think, has recently seen just how bad it is when catastrophe strikes and risk transfer mechanisms are not in place. And so in the next month or so, we will be going to Ottawa with what I think looks like an industry consensus view on mechanisms to address these issues. And we believe we may finally be getting a receptive audience. Chronic optimism is one of my flaws, but at the moment, I think things seem to be lining up in a favorable way on this critical file for PACICC and for our whole industry and honestly for the country. Last thing I wanted to update you on is that we are planning to have a strategic planning conference of our board of directors for the first time. It's happening this June. And we're counting on a deep stakeholder engagement in the run up to that. I will be in touch personally with many of you or your CEOs to make sure we understand the industry's perspective on the key strategic questions our board is contemplating. And I'm very excited about the prospect to have a reconstituted version of what PACICC 2.0 looks like, kind of the next generation of last resort mechanism that we represent. And I will be happy to update the folks at these fora on our progress after our board has come to some conclusions. So that's a very fast thumbnail sketch of what we're working on and the timeline we're working on it. And with that, thanks for your patience with all of that, and happy to throw it back to Ian, and very much looking forward to the discussion this afternoon.
Thank you very much, Alistair. This is a great chance. I always appreciate Alistair giving some words of welcome because it brings the viewers out there up to date on what's going on with the organization here. So thanks for those updates. Now let's introduce our industry panel. I told our folks here that they're rock stars in the industry because we've never had so many people sign up for a webinar and so many organizations. We've got 170 that have registered for this event and over 70 organizations right across Canada. So welcome everybody and welcome panelists. Our first panelist is Jeff Bhamra, Chief Risk Officer and Chief Compliance Officer with Portage Prairie Mutual Insurance Company. Jeff, give a wave so we'll know who you are. Good. Jason Keyfitz, Chief Risk Officer for Trisura Guarantee Insurance Company. Everyone's got the bios, so you've seen the background on these folks. And Marc Lipman, President, Lloyds Canada Inc., and attorney, in fact, in Canada for Lloyds Underwriters.
Afternoon.
So welcome, panelists. We began last year, this is, I think, our third or fourth time doing this, risk identification and risk assessment to start the year for our emerging risks webinars. And when this was first launched, this topic, we were looking for those black swan issues, a discussion of, we know a lot of the prevailing issue, but what's coming down the pike. And people find this really, really helpful. And the satisfaction surveys after the fact that we've gotten just say they enjoyed the discussion so much, because we're really hearing from a broad cross-section of the industry out there. And the panel changes all the time. And the only reason these three are on the panel today is because I reached out and they had time in their calendar and they're gracious enough to accept the invitation. So thanks for being here, but there's no special magic. And ask everyone out there to please keep this in mind. We'd love to have you as a panelist in future. So in the satisfaction surveys that I send out later on, if you're interested in being one of our panelists like this, please let me know in the satisfaction survey. So last year we try to come up with a definition of emerging risk. And we said that there was agreement that an emerging risk is an accelerating risk where the outcome, the implications are not known or clearly assessed, and or where there's not appropriate ownership or classification of the risk. So I thought, let's throw it to the panel to start with. This is just a quick around the horn here. Is that a good working definition of an emerging risk? And people out there, have we missed something with this? So let's get your thoughts on that, and then we'll jump right in. I've got a long series of questions, and we're going to throw to each panelist in turn.
I think it's a fine definition. You know, I think it's a perfectly good working definition.
Okay, Jeff, Mark, you're okay?
Works for this purpose of the conversation, absolutely.
Perfect. Okay. So we've got four categories that we're going to look at today. Tools and risk identification sources. Then we're going to look at specific risks. We're going to look at processes, strategies, and approaches, and then some industry observations from our panelists. So let's jump right into tools and risk identification sources. What risk identification tools do you use? How and from whom do you get risk information in your organization? So I'm going to tap Jeff and Jason for this question. So perhaps one of you can jump in, and then we'll hear from the other about what tools do you use to identify risks in the industry?
I can take that first, I guess. So I think for us, we use both top-down and bottom-up approaches. So we will, obviously get input from senior management, from the board, and then otherwise we are looking at working with all of our department managers, getting input from them, and that will ultimately feed up to our risk register and what we see coming on the horizon. So other than that, we look at information from everywhere. It could be the media, it could be risk reports, it could be business partners, our reinsurance partners, brokers, etc. So we're really trying to capture information, cast a wide net, capture information from all available sources, and feed that up through our risk lens and see what's relevant to our business, to our organization.
Yeah, so I think my answer is going to be, fairly similar. Really, you have to use a lot of different sources, and we have a combination of different tools. We do a survey of a good portion of the staff, managers and above. We do, in one-on-one interviews with the senior leadership in the company, review industry materials, surveys, other publications, news, group workshops with our senior leadership. Sometimes engage external, consultants or other service providers. And I think that it is important to use multiple different tools, both in terms of the source of information and in terms of how you get that information, because each one has deficiencies and advantages that kind of play off of each other. So for example, if I think about the senior leadership, one-on-one interviews get you a certain depth of information, right? You get more time with that person. You get, a lot of detail in terms of what they're thinking, what they're worried about. Sometimes you get insights that certain sensitive topics that might be harder to bring up in a group setting, and that can be easier. On the same time, it can be narrow. People like to talk about what their area of expertise, what their area of responsibility is. And so when we bring it into that group setting, you get those different opinions bouncing off each other and a more rounded view at the end of the day.
Okay, is anyone out there, do you have different sources of information that you use? Just jump in if you can add to that. I see I don't know, Danica, if that's somebody. Oh, okay, somebody coming in from the lobby, sorry. Okay, so let's move on. What sources of information for scanning the horizon for future emerging risks do you use or recommend? And let's go, this is going to be Mark and Jeff. So Mark, let's throw it over to you.
Sure, I'm happy to jump in. I guess Lloyd's benefits from being a marketplace, right? So there's just more sets of eyes and ears sort of scanning the horizon, looking for these issues, looking for risks. One of the things I guess that perhaps we've turned to more of late that's new is really looking for partnerships to help identify and understand emerging risks. And that's not just, outside of Lloyd's, but outside of the insurance industry proper as well. Lloyd's has a very successful collaboration going on with the Cambridge University, the Center of Risk Studies, to look at global systemic risks and other kinds of risks that the insurance industry ought to be focused on, ought to be thinking about how they can respond to. So I think there's great benefit in a diversity of opinion and just, I guess, perspective about where people come from when they're analyzing what's out there that you can bump into in the night, so to speak. So I think that's what we've done of late that perhaps is at least new to the Lloyds Marketplace has been very successful.
Okay. And Jeff, what sources does your organization use here?
Well, we use the PACICC ERM benchmark survey, of course.
That's a good answer. I like that.
But no, of course we use many reports. That being one of them. Definitely, we use the World Economic Forum Global Risks Report. Swiss Re puts out they call it the Sonar Report. Is another one we reference. Aon has a global risk management survey they do, so we use that one. We use Net Diligence cyber claim study to kind of hone in on what's happening with cyber insurance claims and exposure there. And another one that we use is On Risk, which is put out by the Institute of Internal Auditors as well. So those are some of the, I think, the key ones that we've been leveraging lately, but I think as the other panelists have mentioned, there are so many sources of information beyond just reports and studies. There is really talking with your business partners and your suppliers, contractors, your customers, and your employees throughout the organization to source information and see what may be potentially impacting the achievement of their objectives. So.
Okay. And I see no questions or no hands up. So let's move to our next question. At your organization, how does strategic planning and risk management work together on the identification of emerging risks? And how effectively are these functions collaborating to support strategic decisions? So let's go Jason and then Jeff and then Mark on this. This is an all play. So let's hear from all three of you on this.
Thanks, Ian. Okay, so each of these, the risk management processes, the strategic planning, have kind of two aspects. They each have a formal process and they each have a kind of a through the year aspect. In terms of the formal process, the risk management process happens in the spring. The budget and planning, strategic planning process happens in the fall, and they kind of play off of each other. And so in the fall, when we do that strategic planning process, we're reviewing back what were the top risks that we looked at in the spring. We're doing SWOT analysis, strengths, weaknesses, opportunities, and threats. We're looking at the critical success factors for each of the different elements of delivering on that plan and strategy, and what are the risks that are in there. Then in the spring, when we do the risk identification and assessment process, the whole thing is framed in terms of that strategic plan. What are the risks to achieving that strategic plan? Whether those risks are coming quickly, whether they're further on in the 5-year plan, but they kind of tie in together. From the perspective of through the year, all of that foundation has been set from those 2 formal processes. The governance is there. We have the right people being engaged for the right decisions. And so whatever decisions need to be made, are you going to buy a piece of software? Are you going to build it? Are you going to underwrite a certain portfolio? Whatever those different areas are, you have that structure, you have that foundation. So the right people are there, both from a risk and a business perspective to weigh in on those decisions.
That's great. Thank you very much, Jason. And then I think we said we'd go to Jeff on this.
Yeah, I would agree with much of what Jason said. I think our process has been around, during the strategic planning process, we think about the key macro risks and trends that are going to affect our business, our industry, etc. Many of them we're going to talk about today, but and then obviously that will drive some of the strategic planning that we do. And then once those strategic plans are set, approved, and it actually comes down to implementing them, we are again conducting risk assessments to identify what risks are going to impact actually implementing and achieving those strategic initiatives. So it's ongoing and it interwoven throughout, and so we definitely see the two as 2 sides of the same coin: strategic planning and risk management. So.
Okay, Mark, I'll just repeat the question. At your organization, how does strategic planning and risk management work together on the identification of emerging risks, and how effectively are these functions collaborating to support strategic decisions in your organization?
Absolutely. So, I mean, I like a lot of what Jeff was saying. I think, as part of strategic planning, not only does sort of the formal risk function get involved at Lloyd's, but so too do other sort of oversight functions that I guess, again, perhaps are a bit unique to Lloyd's, but there's a performance management team that looks not just at syndicate performance, but also by class of business on an aggregate basis. How are different classes of business that the Lloyd's market underwrites, how are those performing? There is a team on portfolio risk management that will look at aggregation of risks, CAT modeling, different kinds of variables, right? And all of those inputs are used as part of the annual business planning process that each syndicate has to go through, right? So when they come and they talk to Lloyd's about the kind of business that they want to write in the coming year and what are their goals and strategic objectives, what risks are they planning for and how to address them, the Lloyd's has that market view, that aggregated and consolidated view, in addition to the individual syndicate view. And I think that's provides a great deal of additional security around the annual business planning process, around setting appropriate, realistic and achievable strategic goals for the market each year.
Okay, and I invite everyone out there, if you have questions or comments as we go through, we want to make this interactive, like a discussion. It's a bit of a talk show format, and you're certainly welcome to join in. It's kind of an open discussion, and Jeff, Jason, and Mark know that their job here is just to elicit questions, comments from you and keep the conversation going and provide insight into their organizations, and I certainly invite you to be part of the broadcast. So last question, we talked about sources of information, kind of written sources, what's floating around the industry. Do you see value in surveying internal employees and or external partners as part of your emerging risk identification process? Why or why not? Let's go to Jeff first, and then to Mark, and then to Jason.
I mean, certainly there is going to be value there. I think we touched on that earlier, in surveying internal staff and external partners. We tend to not survey our external partners so much as we, would have interviews with them or meetings with them and discuss about, what's keeping them up at night, what challenges are they facing, and then take that information back with us and incorporate it in our risk process. But certainly a survey could be done. As part of our strategic planning process, for example, we did a survey of our broker force. And so certainly there would have been risk information that came out of that. But I don't think you want to inconvenience your business partners too much by making them do surveys quarterly or any sort of a reoccurring frequency. But we were able to do it as part of our 5-year planning process, and so on more of an ad hoc basis. And so that's how we tend to use it. So absolutely, there's value there. And again, the more information, more sources of information you can get your hands on, it only helps. So.
Makes sense. Mark, how about you?
Yeah, what can I add to that? I mean, certainly there's value in getting feedback from both your internal colleagues as well as business partners, right? And so in the Lloyd's ecosystem, we're talking externally to brokers, both in London and across the globe where Lloyd's conducts business. We're talking about the MGAs, MGUs, TPAs, and as Jeff says, I don't think they're as much formal surveys as they are just sort of ongoing substantive discussions about what's happening in those local jurisdictions. What are they seeing in terms of trends and developments? Internally, absolutely, there is formal processes at all times to be able to escalate risks as they're identified. There's also at least a biannual process where I guess all inventory of all existing and known risks are in a sense reviewed, updated. Input is sought from all managerial levels throughout the organization, and that gets obviously consolidated, aggregated, and elevated to executive leadership. So I think back to what I said before, when one's looking for emerging risks, looking to kind of scan the horizon, the greater the diversity of views that you get, the more complete your analysis is going to be.
And so our last question was all about formal documents to identify risks, and this is kind of the informal element. So let's, I have a question here from Alistair, and then we're going to hear from Jason. So Alistair, jump in, and then we'll hear from Jason.
Sure, thanks, Ian. So just on the asking employees, from my own personal experience, I found that 2 different companies, most useful when you were looking at operational risk.
Mm-hmm.
And what we found was that we would go in as management with our list of what we thought the operational risks were. And the employee teams, especially if you went all the way to front line, would not only tell you how to force rank those, but they would raise the ones you had no idea you should be worried about. And especially when operational risk was a newer concept, I'm an old guy now, that was tremendously useful. And then the flip side of that was, I think employees really valued the opportunity to raise questions to make sure their management was thinking about X risk or Y risk. And generally we were. But even that process of validation and showing folks, yeah, we're on top of that one. We have mitigating plans for that. Turned out to be a really useful way to have all the employees gain confidence in the direction and risk management of the organization. So that's more of a comment, but I guess my sense is that the engaging of employees in the risk management identification process can be really helpful, both up and down. For what that's
Alistair, I think you're 100% right. And you talk about it like when it was a new thing. Lloyd's is in the process of revamping its operational risk management process now to try and improve it, to try and garner more valuable input from those that are, that are in charge of those critical processes every day, right? And I don't pretend to know about all of the details, right? I don't think necessarily I should, but I rely on my team to escalate what's important for sure.
Yeah.
Let's throw it over to Jason. Sure, Jason.
Yeah, I completely agree with all that. I think that there's a lot of great information to be gained, themes that you don't expect emerge, a lot of really great insights. At the same time, I also do find that when you make a survey, an employee survey very broad, you also get a handful of people who don't completely understand what's being asked of them, and they give results that are maybe nonsensical and not that useful for you. And so it's important when you make it very broad to filter down. Filter isn't right word maybe, but just process that information so that it's going to be really usable for the end user. And in terms of the external parties, I completely agree. Survey fatigue is very real. Consultants feel it. They're constantly being asked to fill out surveys, and so being very targeted on that, I find is more effective as well.
And it's funny, with young people joining the workforce out there, the key drivers for a lot of them now, so it's not necessarily money. It's being plugged into the organization and feeling they're in on decision making. So this, I guess, kind of echoes that it's just a really good to go around and solicit their views and make them feel plugged in. And if it's helpful or not, it's just a really good exercise. So let's go to specific risks now. Question number 1, fire, cyber, and regulation are significant risks already facing the industry, although they are present and currently being dealt with. The quick evolving pace in each of these areas may qualify them as emerging. Do you share this perspective, and how are you addressing the uncertainty within each of these risks? So let's go Mark, Jason, and Jeff, and we're talking about fire, cyber, and regulation.
Mm-hmm. So multi-parts. First, yes, I agree that I would, while none of them are particularly new, they all are emerging in different ways or evolving. I was a little surprised actually to see regulation on the list, but I think everybody on the phone is probably feeling the additional burden of regulatory demands and requirements, and it does, I think, at some point really constitute a real risk. So it should be there on the list, absolutely. How do you address the uncertainties due to these risks? Well, I guess, you do your best to quantify, right? I mentioned earlier that I have colleagues in a group called the Portfolio Risk Management Team at Lloyd's who are charged with looking at the aggregation of different kinds of risks within the Lloyd's Marketplace. They are working tirelessly on building better fire models to try and measure the exposure around that risk. They're spending an enormous amount of time trying to figure out how to better quantify and understand secondary cat perils, right? Which I guess is sort of a new industry buzzword or term, and all of that, so that we get a better predictor of how those kinds of emerging risks are going to impact the performance of the portfolio, not only by syndicate but across the market as well. Ian, I think you're on mute.
I was on mute. Sorry about that. Let's go over to Jason now. Thank you, Mark.
Sure. I think I'll choose cyber as my working example, and just focus on that. Cyber risk has been high on our risk register for a long time, as I think it is probably for most companies, insurers, and otherwise. And we had a good amount of attention on it, strong controls. At the same time, it was always evolving, but really what happened the last couple of years, changed that. It was this pace of change accelerated dramatically, people working from home. In the past, you had, those high profile cyber events were data leaks, right? And that shifted to be ransomware. It shifted to be business interruption. It really did change. And so I do absolutely consider it to be an emerging risk. And I think the concept of emerging risk is important to get the right amount of focus, ownership, action around these risks. However, I also think that cyber is a good example of why separating, emerging risks from sort of current risks, drawing a bright line between them could be something of a mistake. Whether or not we categorized it as emerging or not, it wouldn't have changed the outcome. It wouldn't have changed how we managed it, right? Really, it prompted a deep dive into our risk and controls, further strengthening our cyber controls, which I think is going to be pretty common throughout the industry. But we didn't sort of separate those two processes. And so for me, it's really about that. Is there ownership? Is there action? Is it getting attention? And after that, I'm less concerned whether I market emerging or not.
Okay, and Jeff, what do you think?
Yeah, I absolutely agree. Two of the three there are actually high on our risk register currently, cyber and regulation. Cyber we're monitoring daily, weekly, monthly, quarterly, annually. We have reporting all on that basis too. It's a rapidly changing area for sure. Regulation, I think the key there is just basically adequate resourcing. If you look at Thomson Reuters put out a cost of compliance report a couple of years back, and they found that approximately on average 25% of our general expenses are really going towards just meeting regulatory compliance. And so it is a huge cost for us, but it's absolutely something that we can do as long as we resource things adequately. So again, it's something we're managing, I think, well. And then otherwise, in terms of fire, it's also an evolving area for sure. Fire risk, especially after Slave Lake, after Fort Mac. So we are looking at our aggregate exposures and are there do we need to adjust where we're writing, where we're not writing, that sort of a thing. And then just assuming that that we're staying within our risk appetite in terms of where we are writing and what we are writing, and then of course working with our reinsurance partners to ensure that as a last resort, Lloyd is on our program, so as an absolute last resort, that we have coverage as well. So
our next question. Yeah. Thank you, Jeff. Our next question is a bit of a deeper dive into that and looking specifically at cyber. And I'm going to call upon Jeff and Mark on this. And so maybe Jeff, I'll just, we'll keep you with the mic here and ask you this. How would the panel assess the current state of cyber risk to clients and insurers? Are the risks well understood? Are insurers responding to provide the right solutions right now? What are your thoughts?
So, obviously there's kind of two angles there, clients and insurers. So I think for our clients are mostly small business, commercial. And so I do think in general, they don't fully understand the risk. I think that's demonstrated by a fairly low uptake on the cyber insurance product. And so, hopefully over time, there will be greater awareness and that will continue to improve. I think insurers very much understand the risk. There's been OSFI regulation in place since 2013 and just recently updated in 2021. So we fully get that. We see the data, we see the claims. So I think insurers, understand, the exposure and that it's ever evolving, ever increasing. 2020 was the worst year on record for cyber claims, and 2021. I think a really great example here is that 2021, our cyber insurer sent us a new questionnaire that asked if we have MFA at our multi-factor authentication at our organization. Well, of course, we had it in place for years, but I think this is where the opportunity is. I think as insurers and cyber insurers, I think we have the data, we have access to the data. And so I think there's opportunity to not wait till, we have worst years on record for losses, for cyber insurance losses, and instead to try and use that early information to educate our insureds on what mitigation they can put in place ahead to hopefully get ahead of large losses coming in and significant losses coming in. So that's where I think we have the opportunity. But so as much as we understand, I think there is still more we can do.
And how about you, Mark? Or what's the state of the industry here? What are your thoughts?
Well, I agree with Jeff that just based on the take up of the product from clients, it appears they might not fully understand the risks associated. There might be other reasons why they're not buying as well. The pricing has been increasing significantly, and it needs to, but there's certainly more room for take up from an insurer's perspective. I certainly hope if an insurer has any kind of meaningful portfolio of cyber risk, they truly understand it. Lloyd's writes, I think, approximately 20% cyber risk globally, and I believe still continues to be the leader in the Canadian marketplace. And we continue to try and up our game on cyber. Some of the things that we've done recently is to try and differentiate between syndicates, those that we think have real deep expertise and allow them to lead in the underwriting of risk versus others that maybe just aren't quite as well versed in the risk and have them just act as follow markets to keep providing the capacity. And capacity does continue to grow for cyber at Lloyd's, but in a cautious and well-mannered way, I guess I would suggest. And I think when you think about the current state of it, the challenge is that it is so ever evolving, right? And as we just started to get used to 2 years of heightened ransomware, as Jason was mentioning, along comes very real and present risks around state-sponsored cyber attacks. And how does the industry deal with that in terms of war and terrorism exclusions to cyber policies that aren't really clearly articulated? I think the industry has worked hard over the past couple of years and made a lot of progress to try and eliminate the whole issue of silent cyber. But just as one might suggest that work is kind of winding up, you get into a whole new issue around uncertainty in terms of coverages around these issues like state-sponsored cyber events and terrorist cyber events, and how does that interplay with cyber coverages and other traditional coverages. So it's an ever-changing field, right? And the industry is going to do its best, but it's a bit like always playing catch up. And you just have to evolve as quickly as possible to try and respond to the risks as it evolves.
I'll throw it out to the audience out there. Does anybody have a question or comment about cyber coverage, the state of the industry right now? Okay, then we'll move on. The next question. As an industry, and this is an all place, so everybody again is on board.
I think Alistair might have a question for us.
Alistair, yes, please. Sorry,
I couldn't resist on this one because I think what's so interesting about cyber is that we're a very traditional industry and most of our risks we're very familiar with over extended periods of time. Mark, you've been insuring boats for 5 or 6 centuries and property insurance for a pretty long time. And we've all been doing car insurance for more than 100 years. And so when new risk categories, entirely new risk categories show up, it's pretty rare and in a way kind of refreshing and exciting. And I think a lot of folks, led by some key syndicates in London, kind of started insuring for cyber more than a decade ago, and everybody else, or many folks, followed. But this risk has turned out to be way more complicated than probability of one car bumping into another. So that's why I think the results have suddenly turned out to be so problematic. And we run a off the record webinar with some of the top chief information security officers at the moment under NDA, where our member insurers are disclosing their breaches to one another and sharing their learnings in ways that have proven, I think, to be quite illuminating, but very sobering as well. And one of the topics we had to brief them on at our last session was problems they were having getting insurance. And so we found the whole exercise fascinating. So in terms of risk identification, this one's clear enough. In terms of getting our arms around it, it's hard for everybody. But as you work upward towards your board of directors how are you able to demonstrate confidence that you've got the right mitigating actions there? And how do you even explain the risk to some of them? I guess would be a practical question in my mind.
It's very good.
Are you asking about the risk to the insurer directly, or are you asking about the insured portfolio?
Oh, I think the risk to the insured, to you. We watched one company pay a $40 million ransom in the last 12 months, just as an example. And so your board presumably is asking, how are you defended against that? What mitigating actions have you taken, et cetera? So I'd be very curious about how the risk team are communicating with the board of directors on this critical and rapidly evolving risk.
Who wants to jump in?
Well, I can jump in to begin with because I don't have a good answer because I'm not formally part of the risk function. But I can tell you, I mean, yeah, Alistair, you're absolutely right, and I think well, everyone on here is a regulated insurance company. I think we've all probably heard from various regulators about even now the heightened concerns that follow from certain geopolitical tensions around the world that don't need to go specifically named. But boards are absolutely asking that. And I know just from being, a member of the Lloyd's leadership team that the investment continues to grow on a regular basis year over year to try and protect the security and integrity of Lloyd's systems, right? And that we know it's probably just a question of when, but not if you come under attack, right? And I think you start from that presumption and build out as the security and safe falls as best you can around from that point, that it's only a matter of when and not if.
Jeff and Jason?
Yeah,
What are your thoughts?
I think for us, it was a question of what more should we be doing, right? And so we opened up, what's the risk? How has it evolved? What other controls are there that we could be implementing? Should we be implementing them? And push the ball forward. So certainly our controls now, our controls before were strong and our controls now are stronger. Are they enough? Are they ultimately where they should be? That's really hard to say, but it is, moving in the right direction. And from the board's perspective, we had a presentation from our head of IT and from our privacy officer, directly to the board on these topics.
Yeah, and just to add to, sorry, there's a question, I guess.
I see a comment came from Evelyn Pang with CAA. For us, CAA Echelon, I find it helpful to have a discussion with our board, not only about our security posture and monitoring dashboard, but about our stance on ransom payments. That was a question that came up in our discussions, is fight or flight. When is the right time to push back and fight? And when should you just give in and pay? So that's an interesting point. Sorry, Jeff, I think I interrupted you. Sorry about that.
No, that's good. That's good feedback from the entire membership here. And so I think to answer Alistair's question, though, from our perspective, very much what Jason and Mark touched on, and we're obviously providing quarterly reports. We're having there's frameworks that we can follow. Right, there's NIST framework, there's OSFI's updated framework, and those will include assessments of how we rate on the various areas of the framework, right, in terms of identifying, detecting, responding to cyber risk. And so, being able to provide and show where we are on that scale, on those scales, and relative to that framework, that helps the board get comfort. And then to Jason's point, what more can we do? Where do we want to invest our dollars going forward? And then the last thing is that we also rely on is third-party risk assessments. So we have numerous external vendors that we'll leverage to perform cyber risk assessments on our organization, and those reports, depending on the nature, will make it to, of course, senior management, but you know, will be rolled up for the board as well. And if there are recommendations, you know, where are we at with those? How are those being addressed? And internal audit is also strongly involved as well in making sure that those recommendations are addressed. So you know, we believe we've created a fairly robust system to ensure continuous improvement in the area of cyber risk.
And I think, Danica, I see you with your hand up behind the scenes. Is there an issue?
Yes. No, not an issue. I received one question via email, and the question is, it's a cyber question. Will cyber become a known circumstance, i.e., everyone will get hacked at some point, and mean it will no longer be insurable?
Interesting point.
Listen, so I think that's a great question. I was going to actually respond to Alistair that I think, you know, I think it's very possible that for systemic cyber risks, they won't be an insurable event, at least not entirely by the private industry. And Alistair may have to add to his list after earthquake and other systemic risks that we're looking to. We should be looking for partnership with various levels of government that systemic cyber might be one as well. And Ian, if I can just, you know, I saw a bunch of comments from people, colleagues in the chat room. I saw them. I agree with all of them. I thought the question about having, you know, thoughtful discussions around ransomware payments, you know, is a really interesting one, right? Because there is a segment of the industry globally that's suggesting ensuring ransomware payments. All it does is foster more ransomware events, right? And it's sort of a self-fulfilling prophecy. And so certain carriers aren't ensuring those payments any longer. And I, you know, I just think that's a really interesting debate that the industry will have and have to come to, I guess, some kind of position on. It might be that some continue to insure and some don't, but you know, the logic behind the stance is pretty easy to understand, certainly.
In our discussion, Alistair was referencing with CIOs and CISOs. We talked about honor among thieves and the fact if you get hit with a ransomware attack, can you actually trust if you pay, you'll get your system back? And they said, actually, believe it or not, it's kind of monetized right now that, yeah, it's probably the more you pay and you get your system back, then it becomes a give and a get. And then you're kind of less guarded to pay because you know you'll get it back, and somebody at some point is going to get stiffed on this. But they say just generally right now there is honor among thieves, that people are finding that they're actually trustworthy about returning your system to you. So it's kind of interesting.
Yeah. I mean, you know, I guess that's some degree of comfort, but you know, I think you've got a lot of other issues if that's what you're taking comfort in at the end of the day.
One interesting aspect of this, you know, to me is how Bitcoin and other similar currencies are supporting this whole thing, right? It kind of doesn't get off the ground unless you can somehow pay for it in an anonymous way without triggering, you know, let's say you have the stance to pay the ransom. You know, how do you pay it without triggering anti-money laundering and terrorist financing sanctions?
Yeah.
How do the thieves actually get the money? So to the extent that authorities get better, and they are getting better at tracking and shutting down, recapturing, you know, Bitcoin wallets and things like that, to me, I think that'll make a big difference.
I see a couple of other comments have come in from Sonia Kundi with Zurich also conduct cyber desktop exercises and develop a cyber response playbook should there be an attack, and also implement training for employee phishing attacks. So that's very important. And then Reem Haleo with Munich said yes, but getting it back doesn't ensure that the ransomware or the hackers out there still don't have a copy and will use it later on. Yeah. Maybe come back at you a second time.
Yeah, for sure. You always have the data leakage, right? That's what we had before, was the data leakage, right? But this is this sort of additional aspect of it that, I mean, who knows which direction it'll go in.
So let's move on to another topic of concern, and it's really catching speed. Again, this is an all play. So as an industry, what role do you think we play in ESG, environmental, social, government issues? And let's go with Jason, and then Jeff, and then Mark. How's that?
Sure. To me, this is a very tricky, very tricky area, very tricky question. It seems to be evolving very quickly, came onto the scene, fairly recently. I think the vision of ESG is commendable. I also think that there's a lot of talk, probably more talk in the economy, not just the industry, but the economy in general, probably more talk than real action. And, a lot of good intentions for sure, but sometimes it can be challenging to roll out those plans. I also think that ESG could pose some of its own risks and unintended consequences. I'm not sure what those would be, but that's what makes them unintended. That's what makes them risks sometimes. And that all the decisions should be filtered through not just what's good for society at large, but also the company and the policyholders and the shareholders and the employees as well.
Okay, thank you. Jeff, what are your thoughts here on ESG?
Yeah, I mean, obviously we absolutely do play a big role. I think governance piece, we have an opportunity to demonstrate leadership there and improve our disclosures. I think on the social side of things, we can encourage ESG initiatives with our customers, our suppliers. ESG incentives, for example, for greener risk mitigation type activities, right? Building back better, so to speak, not just rebuilding back the way that we had previously, right? Having more resilient rebuilding practices and methodologies. So I think, from the social piece, there's a part we can do there. And then I think, obviously from the environmental piece, the climate risk piece, I think the role we have is that we have the data, right? We're at the forefront of what's happening. We see it happening. Yes, BC flood is now visible and prevalent to Canada and governments, but we've been seeing the impacts of climate change for years, and so I think we have an obligation, a societal obligation, to use that data to educate people. To maybe that involves sharing flood maps with customers, vendors, partners. Maybe or maybe it's fire models or SCS models or whatever it is that we think is going to allow people to make better, smarter decisions around climate change. And going back to the uninsurable topic, eventually things won't be insurable if we don't act now and use all the tools at our disposal, whether that's data or information or what have you, to encourage everybody, customers, suppliers, ourselves, governments, to make better decisions for the future. So.
Excellent, thank you, Jeff and Mark. Let's throw it over to you to close
well,
this.
I'll see what territory I can cover that hasn't already been covered. I mean, I guess I sort of take from the question that we're really focused on the E out of ESG, right? I don't think there's a lot of debate around the social or governance components of ESG. The action is all around the environmental concerns and trying to transition to a more sustainable economy and society. So I think, first, our role as any commercial venture is to try and improve our carbon footprint, right? And so, is your office paperless? Is your fleet of cars electric? Like, you could do all of those things. They're important and they're valuable, but obviously the insurance industry really has a much more meaningful role in terms of either the change it can stimulate through massive investment portfolios that our companies manage, and through our support through different insurance products of helping all kinds of industries to transition to a more sustainable business model. I mean, that's really where the insurance industry has an extraordinarily unique and important role to play in all of this, I think. And so, you know, I think the industry, the position continues to evolve. I think, you know, early on, it was sort of the flavor, and this is my words and my interpretation, the flavor was to kind of point out bad actors, right? Ooh, we don't want to insure or have anything to do with those involved in coal-fired energy. And soon after that, oil sands, right? Hitting much more close to home was a no-no, and Arctic drilling. And again, my words, I think that was a crude approach, to be honest, because I think a pound of carbon released into the atmosphere is a pound of carbon. It doesn't matter what industry it came from. The goal is to reduce overall the numbers of pounds of carbon that get released into the atmosphere. And so I think it seems to me a more sophisticated approach is beginning to be adopted and developed. And that's more about the role that insurance companies can play in supporting our customers' transition, right? And supporting their transition to a more sustainable business model, whatever that means. You know, it's always been the role of insurance to support our customers, support them when they were introducing new products, when they're expanding to new geographies. So why wouldn't it be naturally our role to help them mitigate and manage the risks from transitioning to a high carbon business model to a low one? I think, you know, what's interesting about that is it's a whole new discipline of underwriting that's incredibly complex and will be very hard for clients and brokers to navigate because the set of criteria that Lloyd's might use to judge whether a customer's transition plan is credible and can actually be achieved might be very different than any other carriers, right? You know, Marsh has already printed or produced a sustainability index to try and help with that. There will be many others. And so there'll be a proliferation of these things that might end up causing more confusion than assistance, but it's something that the industry is going to have to try and work through. I have great sympathy for clients around this because, you know, coming out of Glasgow, the goal was to get to sort of net zero by 2050. Well, can you imagine really trying to put together a detailed and credible plan that goes out as far as 2050? Like maybe you can do something that's 10, maybe 15 years out that you feel really is credible. Beyond that, a lot of customers are going to need changes in regulation. They're going to need changes, frankly, in existing science and technology that might not exist to help them get to that net zero place. But there's a role for insurance, absolutely, that, you know, is about supporting that change, figuring out how to help underwrite those risks, figuring out how to help provide risk mitigation, consulting, products and services like we always have, and really motivating those changes, motivating clients to continue down a very difficult path, a bit with a carrot and a bit with a stick, with using our investment portfolio to help guide that kind of investment as well. So you know, the role of the insurance industry is I think it's complex. I think it's really interesting and provides great opportunities.
We couldn't get out of a discussion about risks without touching on COVID. So our next question, I'll give you an anecdote on this. COVID is on the wane. I'm downtown in our office, and they've removed the card access to our building now. So you can actually get in the elevator and ride it up for the first time. And my son dropped in here at noontime. He walked into the office. I said, "How did you get in the building?" And he looked at me. He said, "We just got in the elevator. Press the button." Like, it's going on. It's a thing now. So you can actually get in elevators and buildings downtown and ride them. So, okay. So what risks do you, and I'm going to call upon Jeff and then Jason on this in order. Let's have you two answer this one. What risks do you foresee as a result of large volumes of workers returning to offices after the COVID-19 pandemic is resolved? Jeff, let's go to you first.
Well, I'm not sure we'll have large volumes of workers returning to the office after COVID-19 is resolved. But no, I think you know, we do have a duty to keep our employees safe, and you know, I think so. Certainly, there is a risk in having too many folks back too quickly. I think our stance has been, ultimately to wait until things are at more of the endemic level, or the virus has reached a low enough level that, it's really like any other virus that we would have had before 2020. So, it's not going to result in severe or, outcomes for our staff or our employees. So I think that's kind of what we're waiting for. And ultimately we would defer to the experts on that, right? Public health authorities, what are their recommendations? What should we be doing? And so, maybe I'll defer to legal counsel on the panel here, but I think we would also probably talk to our legal counsel and get input as well on these types of issues to make sure we're doing what's in the best interest of our employees. So,
is your organization going to return to normal? Are you doing a hybrid model, or is everybody coming back at some point?
We are in development of our hybrid remote working policy or hybrid working policy as we speak, and currently 80%, 90% of our staff are working remotely. But we do anticipate that may be going, up in the coming weeks to, maybe 25% being in the office, 25 or 30%. But so it would be a gradual return. But even then, I guess to my point off the hop, I'm not sure too many employees are too eager to return to the office either, right? I think remote work has become a way of life for many of us. So I think hybrid is probably the way to go, but again, large groups together, I think we would probably be waiting for public health to give us the thumbs up on that, right? A Christmas party or a quarterly meeting with all the staff or things like that. I think those large gatherings, we need to defer to the experts.
And Jason, how about you? The return to work, first of all these people coming back, the risks associated with that, and then what's going on in your organization? Are you going hybrid? Is everything, someone's going to wave one, at some point it'll be back to normal?
I think that's a lot of, so I'll start with that last question first. I think it's a lot of wait and see. I think it's, softly encouraging people to come into the office when they feel comfortable, but at this point we haven't sort of come down with a very, specific or rigid type of hybrid model. I agree really with a lot of what Jeff said. I think it's going to take a lot of time to get normalized. There have been hundreds of articles written on this topic from lots of different perspectives. There's one thing that kind of I found really interesting that I want to focus on just for a second. One very kind of particular aspect. And we've all heard about this great resignation, right? There's been a lot of articles about that during COVID. And I saw one that characterized this in a way that I found really interesting and really helpful. And in that, the author observed that all of a sudden, many people found themselves in jobs that they hadn't applied for, meaning their job title was the same, their official job description was the same, but their work environment was different, who they were working with, where they were working, their hours, sometimes parts of their job function were different. And so they found themselves in these jobs that they, didn't apply for. They weren't there intentionally, and some of them were unhappy. And so a lot of those people left. Eventually they said, I am unhappy and I'm going to leave. Some left the workforce completely, but I think a bigger number sort of shuffled around to new jobs. And I wonder if some of that might happen in reverse on the other way, right? That people are so used to working from home, or they're so used to whatever environment they're working in, as it starts to shift back into whatever that new normal is, if you could end up seeing another sort of spike in attrition, the way that we saw with COVID.
Okay, great, thank you. And
absolutely, and I think if companies aren't necessarily embracing, hybrid, right? If you're forcing your employees back, I think it's going to be a little bit of a revolt at that point. And you, to your point, you'll see probably an uptick in turnover rates. So.
Are you, Mark, returning back to work? What's the plan at Lloyd's? Small office?
Yeah, small office, to be very fair. So a simpler set of calculus for Lloyd's in Canada. We are returning back to the office probably starting in March. With some flexibility for people as well. I want to see the team to be very transparent about that. I think it's important. I think it's great that people have flexibility. I also think it's important that they work together, that they collaborate, that they can be innovative and creative together. You know, humans are social beings, and 2 dimensions is better than no dimensions, but it's not as good as 3 dimensions. So that's my opinion on it. You know, I guess it's a natural opinion for someone to say from Lloyd's, because Lloyd's is a marketplace. It is literally still a building and an underwriting floor where 80 different insurance companies and brokers and clients get together every single day to transact insurance. And it's probably been the most efficient and successful model in history. So we continue to support face-to-face interaction.
Yeah, I completely agree with that. You know,
Sorry,
I completely agree that there's a huge value, you know, in that face-to-face, and you know, to the extent that people are comfortable, I think that you know, there is that. We do see some teams coming in more, some less, but very much the people that are comfortable, I think they are seeing value in being face-to-face and being there in person.
You know, I think the smarter way to look at the question isn't about in the office, out of the office, real, virtual. I think the better way to look at the question is, how can you make your workforce the most engaged it can be and the most effective it can be, right? And I think those are the 2 questions you should ask about anything that involves your team members, right? Not just about where they're going to physically do their work from and are they going to be in close proximity with other human beings or not, but just it should be one of the dimensions you consider in trying to make your team the most engaged they can be and the most effective they can be.
When COVID first hit, there was real concern in the industry about judicial reach and interpreting contracts. And so the next question is, are you concerned about judicial social expansion of insurance contract wording covering risks such as cyber, pandemic, ransomware payments, etc.? Let's go to Jeff, and then let's go to Mark on this one. So are you concerned about judicial reach into the industry?
Yeah, you know, absolutely. This is, you know, I think for any auto insurer that you're concerned about, you know, social inflation, and then obviously now with you know, what's happened from the pandemic, wording interpretations has become you know, top of radar for many companies. You know, and I think from our perspective, what we try and do is we try to ask ourselves, you know, are we do our wordings say what we want them to say? Are we ensuring what we want them, what we actually want to insure? And you know, again, looking at the business interruption example, you know, we intended to cover you know, loss of profits arising from an insured peril, but you know, until it makes its way through the courts, right? Nobody knows. And we didn't want to insure, obviously, you know, government forced closure of businesses, right? It's 2 very different things. You know, the belief is that, you know, our wordings are sound there, but until, you know, you have the proper legal developments or the case law, nobody knows for sure. And so I think it's just something we have to continue to challenge ourselves on. And not just take the status quo on, you know, using, obviously wordings get used throughout the industry, and so really, you know, stepping back, challenging the wordings, and what are we actually intending to insure, and to get them to the level that we're comfortable with, that's within our risk appetite. And so I think it's certainly. It is something, and as things become more and more interconnected, you know, it's going to become a bigger issue, I think, too, that we're going to have these large, you know, systemic impacts or risks that can impact many organizations, many insureds, and so that's why I think it's very important for us to really think through these and dissect our wordings accordingly.
Mark, what are your thoughts on impacts on insurance contract wording?
Yeah, so I like a lot of what Jeff said. I mean, I think, you know, social inflation is definitely a consideration, but I think it's a slightly different consideration, right? You know, to the extent that courts are broadening their interpretation of existing wordings, or that, more fundamentally, clients and policyholders don't understand the products that they're purchasing. That's a real concern. But I think it's also it's a symptom of the issue that the insurance industry has created products that are too complicated in some respects, right? It wouldn't probably be the same issue it is currently if our wordings were clearer, if people really understood what they're buying, right? The typical business interruption language in the Canadian industry, and this is a generalization, but I mean, it's triggered off of an event of physical damage. So maybe it shouldn't just be called business interruption. Maybe we should be spending more time on trying to clarify our coverages, making them more accessible. Reading an insurance policy, any kind of insurance policy, not only just commercial but personal, it's work, right? And it probably shouldn't be as much work as it is, frankly. I think if that were the case, we wouldn't have, a litany of class action lawsuits around business disruption all around the world, and a number of them outstanding in Canada. I won't discuss this topic without also saying I'm disappointed in the role that the brokerage community played or didn't play in this. They are risk consultants and experts hired by clients to advise them on the coverages that they're purchasing and what they mean. And if that many clients didn't understand what business interruption meant, I think there's a lot of blame to spread around that. And I haven't really seen too many brokers stand up and accept their share of the blame on that. But that doesn't mean that insurance industry can't do better in the way we craft our products and draft our insurance policies.
I'll do a check-in with the audience out there. Any concerns you have out there about insurance contract wording? Give you a chance to jump in. Failing that, okay, I'm going to move on to the next question, and I'm going to invite Jeff and then Jason. So what risks do you foresee from non-traditional business disruptors such as Google and Amazon? What are your thoughts there? Let's go to Jeff.
So I don't think that insurance industry profits are anywhere near the kind of profits that the tech sector is used to seeing. So I don't think going after our business, trying to sell it, underwrite insurance is necessarily their play, is necessarily the tech companies or disruptors play. I do think that what they do really well is leveraging their data and their technology to act as an intermediary to other products and services, right? So, I could certainly see them being an online marketplace where insurers can sell their products, right? Or partnering with or partnering with an insurer or selling their data to businesses for a fee, for example, right? And same thing if they were acting as more of an online broker or online marketplace and selling insurance, maybe they're collecting, again, a small commission or a small fee on many transactions. I think those are more of the types of plays that are suitable to large tech players, large disruptors like that. But so I think for us, our view is again, they're not trying to be the next Intact or Aviva or Trisura or Portage Mutual. So that's kind of our view. Again, just based on pure return on investment for their shareholders.
Yeah,
Okay.
I mean, I agree.
Jason,
we haven't
sure.
seen, yeah, we really haven't seen that, we've seen innovation, definitely around the edges. We've seen some innovation, but nothing that I would say has really truly disrupted the industry. Something may be lurking. There was an interesting article I saw earlier this week in a Society of Actuaries publication called Contingencies, and it focused on Tesla. And apparently, Tesla offers auto insurance to Tesla owners in the state of California and now the state of Texas, and they're expanding nationally across the United States. And Tesla uses the driving statistics from their vehicles to price the coverage. So it gives them quite a big data advantage, which gives them a big underwriting advantage. I don't know what their margins are. Yeah, I think that, Jeff, I think that's a good point. I don't know their margins. I suspect they may be pinching margins from the broker as well, not just from the insurer, but on the distribution side. What was really, really interesting about this article, well, first, what's interesting to me is that they're not going ahead and saying, I'm going to do insurance. They're taking a product that they have that's not an insurance product with its own data, and then they're using that existing data to kind of pivot. The article observed that tech companies have really shown over the last decade that consumers are generally willing to give up their privacy to get cheaper products, right? Think Facebook, think Google, think all of these targeted advertising, based products. And that's very interesting. It's very much not how we in insurance think, very much not the sort of privacy mind that we generally have. But if these are other tech companies, take their non-insurance products, take all the data they've gathered, and they want to underwrite, they probably are going to do a better job. They're probably going to be able to underwrite better. Are they going to compete directly? Not, it's hard to say, but there's definitely a data advantage to be had in some areas. I'm thinking, the Apple Watch comes to mind. That's not a product. We don't write health insurance, but the amount of health data that's coming out of the Apple Watch is tremendous. I'm thinking, Facebook, the amount of data there's a lot of these different areas where if you could have access to that for underwriting purpose, you could really have a big advantage in underwriting better than your competitors.
I want to respect people's time here. I know we've got probably about 8 minutes on the clock, and I've got 2 more questions. This question is going to be for Jeff and Mark, and then I've got a question on all play to close the broadcast. So it's follow on about disruptors. So Mark, let's throw it to you. What are some strategies to stay ahead of non-traditional disruptor risks in the marketplace?
What are some strategies? Well, I think the industry's actually been pretty successful in terms of staying ahead by engaging with disruptors and engaging in the broadest sense, whether it's partnerships, whether it's acquisition, investments in them, but incorporating disruptors into the business process of existing insurance companies seems to be a model that's working. There used to be a lot of talk about insurtechs disrupting and taking over the industry. I think that narrative's pretty dead now. I think the role for insurtechs is much more incremental, and how do they improve a certain component of the insurance process or value chain, and how do they partner effectively with incumbent insurance companies to do that? So I think being aware of the opportunities, looking at it like an opportunity, engaging with that community can be one way. I wouldn't say to stay ahead, but to certainly leverage and remain relevant as a traditional insurance company. I mean, and just if I can just have an extra second or two, to the points that both Jeff and Jason just made on your previous question, I agree. I don't think Google or Amazon wants to be a traditional insurance company, because absolutely right. It's way too regulated for them. The margins are too low. They got a million other things they can do to make more money. But what I am concerned about is, and it was kind of referenced, the cannibalization of the traditional market for insurance companies, right? And so, Apple could easily get into insurance just for the purposes of selling product warranty on their devices. And I think they would do extremely well with that, right? And they would have the first point of contact to sell that product related to all of their phones, their watches, their iPads, their laptops. And that segment of the industry would be, well, that segment or class of business would be lost to the industry. And when you think about, the discussion around autonomous vehicles, and when they are really truly functional and ubiquitous, it almost ceases being automobile insurance, maybe becomes product liability. But the parties most likely to market that insurance and sell and be successful with it are the manufacturers. And that's a very big deal when you take a look at the Canadian insurance industry and how much premium is related to automobile insurance, right? I mean, it changes the entire nature of the Canadian insurance industry if that day comes. So to me, the cannibalization of the industry through like, specific niches and products is the concern.
One of our viewers out there just noted as well, the tech companies are accepting crypto and Bitcoin currencies. So is there pressure on companies doing that as well? But let's go over to Jason, the risks you foresee. Or I'm sorry, no, this was back to, to Jeff. Strategies staying ahead of disruptors in the marketplace. What are your thoughts, Jeff? Sorry about that.
Sure, no problem. I think, if you look back, if you go back in time, maybe 15 years ago or so, the way that we all used to buy travel insurance, purchase, travel, a trip or whatever, book a trip, was totally different than what it is today, right? Obviously, we might go to a travel agent, and today you're going to, Expedia or Booking.com or Kayak or whatever the website is. But that being said, I think if you look around your city or your neighborhood, you're still going to find quite a few travel agents. Probably they don't have as much of the market share as they used to, and they probably aren't as many of them, but they do still exist. And so I think for us, I think our key is trying to understand like what is the value proposition that we offer, and just continue, and then where are the opportunities, and continuing to focus on that, because obviously our size insurer, we certainly don't have the capital to compete with Google or Amazon or large disruptors, but the value proposition that we bring is I think in tailored products, insurance knowledge, expertise, service, etc. And so there is we believe that there is a market for that, and so that's how we want to continue to exist for the future and remain competitive and relevant, as Mark touched on. So we're looking at our value proposition and the opportunities there, and continuing to move in that direction.
Okay, I have one more question, and I'm going to put it to each of you for 60 seconds, 60 seconds or less. In your career, what emerging risk was the most difficult for you to get your organization to take seriously, and how did you do it? And maybe you didn't do it. Did your organization accept it or not? So what was the toughest? And let's go Jason, and then Mark, and then Jeff. 60 seconds each. Go.
Oh no, I'm on the clock. So. COVID is an interesting example. Maybe it's not a perfect example to fit the question, but it was on my radar, fairly early, and there was just a little bit of news about China, and no one was really expecting it to come to North America, certainly not as severely. And so when I brought it to the attention of my colleagues, no one really knew what to expect, how it could impact the company, when it could impact the company. And but that risk did emerge pretty quickly. And so it wasn't so much my own convincing, but time to sort of absorb it, time to think about it, news, reading external sources that really brought that home. And at the end of the day, I think that early conversation, even though it was not very well formed, right, the risk, but the early conversation did eventually help, drive a swifter and more effective response at the end of the day.
Okay, great. Thank you. Next. Mark.
60 seconds. So let me try and answer it a little bit backwards. The most pressing risk that I think I ever faced, but one that everyone recognized and rallied around was, at the time, the company I was working for at the onset of the financial crisis, right? And literally talking about and making sure about the viability of insurance companies. But there was consensus, and everyone marshaled and focused on doing the right thing. The issue or risk that's been toughest, I think, to get people to really to engage around was, just up to a couple of years ago, 10, 12 years of a soft market with deteriorating pricing, deteriorating rate and terms, poor investment returns, and just all of these things slowly dragging performance and results down, but for a whole industry. So you were no worse off than anyone else. It was a collective malaise that no one felt they could really effectively do something about, because, well, I gotta shave off some points on the renewal, otherwise we're going to lose the risk. Well, maybe they should have, right? And it took a confluence of different factors to get the entire industry to kind of wake up, and generate a hard market that arguably got us back to somewhere close to adequate technical pricing. But you know, it was sort of 12 years in the coming to get people to really make a move on that. People knew it. People knew their portfolios weren't performing the way they wanted them to, the way they would have to for sustainable long-term profitability, but it was just couldn't do anything about it for the longest time.
Okay, thank you, Mark. And Jeff, to close, most challenging risk you've dealt with, emerging risk.
Yeah, I think my experience was almost very similar to Mark's. I started in the industry about 12, 13 years ago, and a couple of years in my time in the industry, our company was going through significant losses year over year, and so we our underwriting risk management, our claims risk management, they kind of needed an entire overhaul to really return us to profitability. And I think those of us who were involved in some of the risk realm, saw this, and I think we had some conversations with our leaders about it. And I think basically that's how we brought about, helped to bring about changes, is just through, as Jason mentioned, asking the question, have you thought about this? Is there more we can do from pricing and risk selection perspective here? How is our reserving practices? And just questioning the status quo of what we had done for many, many years that had served us well to that point, but no longer were. And so through that, we built consensus around where we needed to go next, and ultimately we were able to turn the company around, I think, in many respects, and have had profitable. We've had underwriting profits the last 4 out of the 5 years. So it's been it was obviously many people involved in that, but I think. If you recognize an opportunity there, I think you have to bring it forward and discuss it with parties and try to build consensus.
Excellent. Okay. That's an excellent spot to wrap up discussion here. I want to thank our panelists sincerely. Rock stars in the industry, you'll be recognized as such in future industry meetings. There they are. We've had Jeff Bhamra, Chief Risk Officer and Chief Compliance Officer with Portage Prairie Mutual Insurance Company, Jason Keyfitz, Chief Risk Officer with Trisura Guarantee Insurance Company, and Marc Lipman, President, Lloyds Canada Inc., and Attorney in Fact in Canada for Lloyds Underwriters. So thank you very much for being part of this. Danica is perfect, has put on, this is the schedule of events, the Risk Officers Forum meetings for the year, April 14th, September 15th, and a date in November to be determined. We're going to try We're going to try to twin it with the OSFI Risk Management Seminar. Don't know if they're going to continue to have a full day, and if they do, will be the day right after that. But very exciting. Our next event is the April 14th. Sorry, Danica, can you go back one slide? April 14th Risk Officers Forum, and we have Jackie Friedland coming in from OSFI. She's confirmed to give you kind of the 6-month check-in from their fall risk management seminar. They're using our April meeting to always update the industry, kind of a 6-month check-in. So it should be packed. And those are the other issues we're going to talk about: model risk and operational resilience, operational risk. And then September 15th, we're going to hear from the CEO talking about the risk function and balance with regulatory risk. We're talking about inflation, which is on everyone's mind right now, and human resources and talent management. We talked about that in a previous meeting, so we're going to come back to that and revisit that in this COVID world, post-COVID, hopefully. And then finally, in the last forum meeting of the year, we're going to hear from PACICC's board chair about the strategic planning conference that we are having on June 9th of this year. And it's going to take a real look, a hard look at PACICC and the function, the role we play in the industry, and how we can best serve member companies going forward. And then we're going to talk about class action status and an update on that, and supply chain risk. And then the emerging risk webinars. if Danica, or I'll just prepare we have 2 webinars planned. May 19th, we're going to be doing climate change modeling, and Thursday, October 20th, looking at privacy and managing compliance and reputational risk. And so all our events, make it easy on you out there. They're always on Thursdays now, so make it very easy. You're going to be getting, and thanks everyone for being on the broadcast, you're going to get a satisfaction survey tomorrow. We're going to ask your thoughts on today's broadcast, ways we can improve, and what you enjoyed about today. And certainly invite you to be part of a broadcast like this in future. So put your name forward if you'd like to be a panelist in future. And I think that is a wrap for today. So thanks everyone for joining in. Thank you to our panelists, and it's been a great discussion. So be safe, and we will see you in April. Okay, all the best.
Thanks, Ian. Thank you.
Thank you.
Thank you so much.
Thank you, Ian.